Is there a hedge against falling home values in the future? Well, remember 2008 or 2009 or 2010, any of those years? Those were years when home values fell. Some homes dropped in value by 30, 40, or even 50%. Well, I was around for that meltdown. In fact, I wrote hundreds of articles back then about the financial and foreclosure crises, and I'm proud to say that I helped save thousands of homeowners from losing homes to foreclosure. Of course, some people were able to ride out that storm. But if you were counting on your home's value because you were retiring, then it was a nightmare. Can the same thing happen again? I mean, if it happened once, can't it happen again? Well, no one knows when, but we should have all learned that what goes up can also come down. So what can you do to protect yourself against falling home values? It's called a HECM line of credit, and used properly, it can provide a hedge against falling home values in the future. The HECM line of credit is the only line of credit available in the country that's guaranteed to increase each year regardless of whether the home increases in value or not. It goes up every year by whatever the interest rate is plus half a point. So let's say the interest rate is 3.5%. Plus half a point is 4%. That means that in that year, if you had a HECM line of credit of $250,000, the next year it would increase by 4%, and 4% of $250,000 is $10,000. So next year, your HECM line of credit would increase to $260,000. Then let's say that the following year interest rates rose to 4.5%. That means that year, your HECM line of credit would increase by 5%. 4.5 plus half a point. 5% of $260,000 is $13,000. So that next year, your HECM line of credit would increase by $13,000 to $273,000. And that growth in your line of credit would keep growing and compounding year after year, regardless of whether your home's value went up or down. No matter what, your HECM line of credit continues to increase every year. It shouldn't be hard to see that over time, that line of credit growth adds up to real money. Let's say that you set up your HECM line of credit when you were 65, and you didn't use the money because you didn't need it. 20 years later, when you turn 85, that line of credit would be roughly $725,000, assuming a growth rate of 5% each year. Of course, if interest rates were to rise above 5%, that line of credit would go up even higher. And that money is available to you tax-free, irrespective of the home's value. That's right, your home could go down in value, but in that example, you'd be able to pull out $725,000 at age 85, tax-free, and use the money for any purpose. Now, the HECM line of credit is a revolving line of credit, so you can also use it along the way. You could take $50,000 out one year and pay it back the next. It's totally up to you. And any payments you make into the HECM line of credit will appear on your line of credit dollar for dollar. That means that you can pay the money back into your credit line and then get it back whenever you need it. But maybe the best part of the HECM line of credit is that if you do borrow from your credit line, you don't have to make any payments on the loan if you don't want to. You can make interest-only payments, you can decide to make principal and interest payments, or you can choose to make no payments, in which case the interest would simply be added to your balance and repaid when you either died or sold the home. Now, the HECM line of credit is only available to homeowners over age 62, and they have to have roughly 50% equity in their home. And they must continue to pay their property taxes, insurance, and regular maintenance, but that's it. They never have to make a payment on money that comes from their HECM line of credit. They control the mortgage instead of the mortgage controlling them. There's nothing else like the HECM line of credit. Nothing else will do what the HECM does. And HECM stands for Home Equity Conversion Mortgage, and it's part of the federal government's insured reverse mortgage program. HECMs were created by Congress. They're regulated by HUD, and they're insured by FHA. So you know your line of credit will be there when you need it, unlike a HELOC, home equity line of credit, which can be canceled unilaterally by the bank at any time. Your clients that own homes and are over 62 need to know about the HECM line of credit, and so do you. Click my email address below. I'll get in touch, and you can learn the ins and outs of the HECM line of credit. We can either talk on the phone, or I'll set up a Zoom meeting, and we can meet on Zoom. That's all the rage during these crazy times, right? Yeah, I know. Look, the HECM line of credit is a very important financial planning tool, and it can be a powerful hedge against falling home values in the future. It can also be used to protect you later in life when you might need in-home care or long-term care, because you can use the funds from a HECM line of credit for any purpose whatsoever, tax-free. And tax-free is a lot better than pulling money out of a 401k or an IRA, because those dollars are taxable as ordinary income. And once you withdraw money from those accounts, it's no longer invested. So not only do you pay taxes on the withdrawals, but you also lose out on the future returns. But with the HECM line of credit, your home continues to appreciate, even though you've pulled money out from your credit line. It makes a lot of sense for a lot of people, more and more every day. In fact, over 1 million homeowners today in this country have HECMs. Isn't it time for you to learn all about how they work and how they can be used? I think it is. I've spoken with hundreds of financial advisors, attorneys, and CPAs from all over the country, and every single one of them was glad to have learned about the HECM program. You will be too. So just look, click the link below. Send me an email. I'll respond right away, and we can put something on the calendar. It'll take less than half an hour. I'll answer all of your questions, and I'll send you materials that you can keep on file. That way, you'll have the facts. The next time a client asks about withdrawing taxable funds from their qualified retirement accounts, you can suggest that maybe they should preserve their retirement wealth and look at taking funds from a HECM line of credit instead. I hope to hear from you soon. I really do. I'm looking forward to talking with you. It's my favorite subject these days. And thanks for watching.